Hello, Hawaii residents. Thank you for joining me today. We want to talk about the bank statement loan program that's available in the state of Hawaii. And for those of you who have not heard of a bank statement loan before, it's usually for self-employed individuals who cannot qualify with the income verification that is cited on their tax returns because maybe there are too many write-offs. And it's not just for self-employed, it's also for individuals who may be 1099 employees that do not have the taxes taken out or have difficulty, again, qualifying based on their tax returns. They're treated very similarly within this program. So that's who the program is for. Now, what are the benefits? Again, the fact that you don't have to qualify using your tax returns is a benefit because so many of you show either a loss or very low income after you take the various legal write-offs into account on your tax returns. And so it's really not fair for self-employed people. When you think about it, you have cell phone bills that you may write off as a business person on your tax returns, and that's reducing your income, but you have a W-2 wage earner who may also have a cell phone bill, but that's not looked at, or that's not a reduction of income on the mortgage application for someone who is applying that's W-2, and nor is it considered a deduct from a liability perspective. So that's why it's difficult, and that's why a program like this is beneficial. And that, again, the main benefit is to be able to qualify for the loan amount that you need. You'll need to provide anywhere from 12 to 24 months worth of your bank statements. And what the underwriting team would do is they'll look at your average monthly deposits. So you could have some heavy months, you could have some months with no deposits, and that's why they will use anywhere from 12 to 24 months to figure out what your average monthly deposits are. And then from there, they'll use a percentage of that average as your income, your gross income on your loan application. Now, credit scores are a factor. In some instances, you're going to bottom out on the credit score where you just can't get this program if your credit scores are too low, into the low 500s. Now, the down payment for this program is going to be based upon your credit scores. So, for example, for a traditional bank statement loan, the best down payment you would find is 10% down with excellent credit. And then you might go all the way down to credit of 580, 550, where you're looking at putting 30, 35% down. Now, we do have a 3.5% down option available, and that's for credit scores of 660 or better. But that's a very different, very unique program. And if that's something you need or you're interested in, you'll need to contact us at dreamhomefinancing.com. I'll put a link down below in the description and also the first pinned comment. It's not your traditional type of mortgage, but it's great. In fact, the rates are a little bit better on that program than the regular bank statement loan. So let's talk about that. So what kind of rates can you expect from a bank statement loan? And one example would be you might get a rate, say 2% higher than conventional rates, prevailing conventional rates, or depending on your credit scores. So you could expect a higher interest rate. But for that 3.5% down program, the rates are not, the gap is not as wide. It's actually, the rates are more competitive with that 3.5% down program. Down payment assistance, you may or may not be able to use down payment assistance with this program, but it's something you'd have to secure outside and outside of the program on your own in your community, and maybe they will provide you with enough to help you to bridge the gap between what you have saved and what the down payment requirement is. Now, the other types of programs that are available, or the other scenarios, not programs, that are available with the bank statement loan would be a refinance. Maybe you want to refinance to get a lower rate versus what you may have had originally. You could refinance to get a lower payment. You could refinance because you may be in a bridge loan where it's the note's coming due, or because it's an adjustable rate mortgage and you don't like what the the adjustment rate is going to look like and you're worried about the future. You could also get this mortgage to cash out, do a cash out refinance on your home for this. And you will be capped though at, especially when cashing out, you'll be capped at anywhere from 70 to 75%, in a rare scenario 80%, but 70 to 75% cash out of the loan to value ratio. So if your home is worth $1 million, then the highest loan amount while cashing out would be $700,000 or $750,000. Hopefully that makes sense to you. And on a rare occasion, we might be able to find you a HELOC option if you do not want to lose that first mortgage and that first mortgage rate. Keep in mind, the HELOC or second mortgage for this type of program is going to be very expensive. The rate will be very high. So what we always do is the math for you to say, okay, here's where your current rate is. Here's where the prevailing rates are for bank statement loans. Here's where the HELOC rate would be, and what would the blended average look like on your payment if you had you kept your existing mortgage and got a second versus if you just refinanced the first to a little bit of a higher rate, what would your payment look like? So those are things that we'd help you with. Now, if you want to talk about this further, you want to speak with someone, you want to get a quote, you want to understand what it would look like for you, you have a scenario you want to discuss, just contact us again at dreamhomefinancing.com and put a link down below in the first pinned comment. If you found this video to be helpful, I would appreciate you if you hit that like button, because it helps others to see it when YouTube sees that someone else has enjoyed it. So thanks again, everyone, and I hope that we get to speak to you soon. Have a great day.